Welcome to Pankinen Financial Perspective with Ashton Pankinen from Pankinen Financial Group. Planning for your financial future means navigating challenges like market volatility, inflation, and retirement income. Pankinen Financial Perspective is here to help by addressing common financial concerns, sharing valuable strategies, and exploring ways you can work toward your financial goals. Now let's get started with Pankinen Financial Perspective.
Hello and welcome to the Pankinen Financial Perspective. My name is Ashton Pankinen from Pankinen Financial Group. If you'd like more information about what you hear during our show today, give us a call at 952-873-2703 or visit us online at pankinenfinancial.com. That's PANKONIN financial.com. And while at my website, click on the radio page to check out past shows and to subscribe to our program on Apple Podcast, Spotify, or Amazon Music. Also while at my page, click the link at the top to get the latest retirement guide. When the Federal Reserve makes a move, it's not just a headline, it's a ripple that touches everything from your mortgage and credit cards to your savings account. The recent decision to cut rates is no exception. For everyday people, the impact may feel both promising and confusing. Lower borrowing costs might open doors, but shifting yields and market reactions can also create new challenges. Today, we're unpacking what this rate cut really means for you, your debt, and your long-term financial strategy so you can approach it with clarity and confidence. But before we jump into that, let me introduce my co-host, Tony Shore, who's hopefully doing better than our Vikings.
Whoa, yeah, let's not talk about our Vikings. I love the Vikings. I'll support them. Yep. Not a bandwagon jumper. I've been on the Vikings bandwagon, never gotten off. But even through the Lou Holt years when we only won one game, I think.
That was a little before my time. But
yeah. Okay. Enough with the age jokes. But no, seriously. That last game, holy shnikes, we looked bad. Hopefully they'll get it figured out.
Strengthen up that interior line, and I think we'll be okay.
Yeah, I would agree. Yeah. I would agree, and maybe figure out the quarterback thing and the interior line, though. That's where it starts. So yep. But we're not here to talk about football. We're talking about the big news. I mean, the Vikings losing badly is not necessarily big news, unfortunately. But the Fed's rate cut. That has real world stakes, and I'm excited to dig into what it means for everyday families out there. Ashton.
Yeah, and during today's conversation, Tony, we're going to be referring to a very eye-opening article from NerdWallet that's headlined "Fed Trims Rates. What does that mean for you?"
Yeah, and I think that's great. And there's no reason to keep us in suspense here, Ashton. Take it away. Where do you want to start?
Yeah, so here's the headline. For the first time in 9 months, the Fed's decided to cut interest rates. And that's a pretty big move. And for consumers, it usually boils down to two main effects. Borrowing gets a little bit cheaper, and the returns you earn on your savings accounts or CDs aren't quite as strong as they were.
Sure.
And so just to set expectations, these changes don't happen overnight. They take some time to trickle down into everyday life.
Yeah, I mean, people think, oh, the Fed cut rates. Now I'm going to refinance my mortgage, or now I'm going to buy that house. It doesn't happen quite like that. Although sometimes the markets anticipate, and maybe they've started changing, but typically these things do take time. And for the average person, maybe they'll save a little on things like credit cards or loans, pay a little bit lower interest, but they'll probably also notice some of those fixed accounts like CDs, savings accounts, not paying quite as much interest, right?
Yeah, that's exactly right, Tony. The Federal Open Market Committee, or the FOMC, which is basically the Fed's decision-making team, voted to cut federal rates by 0.25%, which brings that range down to about 4% from 4.25%. And the last time they cut rates was back in December of 2024. And after a string of earlier cuts, since then rates have mostly held steady in that mid 4% range. And the chairman, Jerome Powell, called this move a risk management cut. So think of it, Tony, like tapping the brakes when you start slowing down in traffic up ahead. You may not be in trouble yet, but rather ease up early, then slam on the brakes later. And while there's been some political pressure to cut rates faster, Powell made it clear the Fed is looking at economic data first and foremost, not the pressure from the political side of it. And so one big reason for this decision is a softening job market.
Oh,
So when hiring slows down and unemployment starts to creep up, and the Fed sometimes acts to cushion the labor market. So right now, their message is clear. Keeping jobs stable is more urgent than pushing inflation down, even though rising prices are still in the picture.
okay. So they've switched from moving rates up and down to affect inflation, and they're focusing on what can they do that'll help cushion that labor market issue as unemployment creeps up. And so they decided to lower rates, and maybe they'll lower them one more time this year, one or two. So if I'm hearing you right, it's not exactly a, hey, things are great kind of move. It's more like the Fed saying, we're worried the job market's cooling off too much and we don't want it to get worse. Am I right?
Yeah, that's very nicely put, Tony. Paul even called the current situation a curious balance. Normally, when you hear a balance, you think stability. But in this case, it's more about both supply and demand for workers have come down and demand is dropping a little faster. So that's why we're seeing unemployment edge upward. So now here's an interesting wrinkle, Tony. Not everyone on the Fed committee agreed with this rate cut. Actually, the newest member, Stephen Myron, voted for a bigger cut, 0.5% instead of 0.25%.
Huh. That's a pretty bold stance for a new guy, isn't it?
Yeah, it is. It is. Myron just appointed earlier this week. He's stepping away from his role as chair of the White House Council of Economic Advisors so he can serve on the Fed. And so right out of the gate, he's making his voice heard.
Interesting. Do disagreements like this happen a lot, or do you think this is kind of unusual?
Another great question, Tony. Dissent on the FOMC isn't unheard of, but it doesn't happen often, especially in recent years. The fact that we're seeing it now says a lot about how tricky the economy is to read right now. Between the cooling labor market, stubborn inflation, and political pressure, it's no surprise that these experts might look at the same data and come up with different conclusions.
Yeah, I get it. Shouldn't be surprising then. So there's just no perfect playbook right now, and that leaves room for some honest disagreement, right?
Yeah, you got it. I mean, this moment is ripe for a little debate, and that's where we're seeing it play out.
Yeah. So then for the average person, it's probably the difference between rates are lower. Should I maybe refinance my mortgage versus does refinancing even fit into my bigger financial picture? And are they actually lower enough to make it worth it?
Yeah. You know, we want to take someone who's close to retirement, who's debt free, Tony. For them, chasing a refinance might not move the needle much at all. But adjusting how they allocate savings and rethinking their bond ladder or CD strategy could make real difference in their income plan. And that's where, you know, meeting with a financial advisor can help separate what's worth acting on and what's just noise.
Well, speaking of meeting with a trusted financial services professional or an advisor, Ashton, how can our listeners out there get a hold of you and your team to set up a no charge, no obligation consultation to get a plan in place?
Yeah, Tony, listeners can visit my website, pankoninfinancial.com. That's PANKONIN financial.com. Or the best way is to call my office at 952-873-2703. Again, that number is 952-873-2703 to discuss how we can answer your questions and address your concerns about interest rates, your financial strategy, or any other parts of your retirement. It's our goal to help you prepare for the retirement you've worked so hard for.
I would agree. And you've been giving us some great information on the Fed's recently announced rate cut and what that might mean for people out there, our listeners, and their financial strategies. You've been referencing an article from NerdWallet called Fed Trims Rate. What does it mean for you? Some of the numbers are in that article and some of the facts on this, if you want to look that up. But let's get to the question that's probably on a lot of people's minds. What actually happens when there is a rate cut? I mean, it doesn't mean everything instantly gets cheaper, does it?
Yeah, interesting question, Tony. A short answer is no, not instantly. A rate cut doesn't just flip a switch, but it does set some changes in motion. So think of it like turning the thermostat down in your house. You don't feel the temperature change right away, but over time, the room adjusts. And that's how rate cuts work for the economy. So first, borrowing usually gets a little cheaper when the Fed lowers rate, the Fed fund rate. Banks pay less to borrow money from each other, and in turn, they often offer lower rates on loans. And that could mean lower interest rates on credit cards, auto loans, mortgages, personal loans, you name it.
Wow. If somebody already has a mortgage or a car loan, does that mean they can automatically save money then?
Not automatically, but this should open the door for refinancing. Lenders may lower rates on refinancing, and that can create opportunities if the numbers do make sense for you. But on the flip side, savings becomes a little less rewarding. So banks tend to reduce that annual percentage rate or APY on savings accounts, CDs, and interest-bearing checking accounts. So while borrowers may cheer, savers may not.
Yeah. And then there's the market piece, right? I mean, the market always is affected by this.
Yeah, indeed, Tony. The rate cuts can be a mixed bag for markets. Cheaper borrowing can boost business confidence, which is good for growth and corporate profits. But investors believe the Fed cutting rates is because the economy is struggling. Then the markets can get shaky. In fact, right after the latest cut, the Dow dipped briefly before bouncing back.
Yeah. And so, okay, the bottom line is then don't expect magic, but over time, the hope is lower rates will give the economy a little extra fuel, correct?
Yeah, that's precisely what Powell emphasized. One cut may not be visible right away, but the goal is stronger economy and healthier job market over time.
Sure. Well, and I know here's another big question I've heard people ask. Does this mean the Fed's going to cut rates again? What are your thoughts on that?
Yeah, it's possible, Tony. I mean, maybe even likely, but nothing is written in stone on that. Powell himself called it meeting by meeting situation, which basically means they're watching the data closely and adjusting as they go.
Okay, that's good. So obviously, people need to understand this, and I think it sounds what you said is a careful way of saying we're not sure what comes next, is what they're saying, right?
Yeah, Tony, I think that's right. He even admitted that this is an unusual spot because the economy isn't what he'd call bad, and it's not a recession scenario. So the path forward isn't crystal clear. His words were, it's not incredibly obvious what to do. So now if you look at the Fed's own projections, it suggests more cuts could be coming at the remaining meetings this year in late October and again in December. And future market agrees because tools like FedWatch show how strong odds of cuts at both meetings coming up.
Right. Yeah, there you go. Well, that's good. So in other words, the odds lean toward more cuts, but Powell's basically reminding everyone out there, don't take anything for granted. Right?
Yeah. No, exactly, yeah. Tony. And since we're on the topic of Fed rate cut, let's turn the spotlight on what it could mean for the housing market. So now, even if you're not planning to buy or sell a home anytime soon, housing is often a predictor for the broader economy.
Well, yeah, it really is. That's really understandable because when the housing market shifts, it tends to ripple out into so many other parts of people's lives and spending. It's like throwing a large rock into a calm lake. The ripple effect can spread out across the entire thing.
Yeah, bingo there, Tony. So let's look at another article from NerdWallet. What the Fed rate cutting plans mean for the housing market. So to put it bluntly, this latest rate cut could be the signal for some buyers have been waiting for. Normally, when rates drop, you'd expect demand for homes to pick up.
Well, yeah, the housing market has been it's not been great. It's been kind of tough. I mean, with higher interest rates and things. Yeah. But maybe some lower mortgage rates might mean, hey, maybe I can finally afford that payment. But, with my wife and I, we have a locked in 2.9%. Right on our mortgage. So, which is awesome. Right. But all our kids are out of the house and we've been wanting to downsize and maybe move to a one level, you know what I mean? A ranch or a Rambler style home, one level. But we've looked around and even if we see something, we're like, yeah, we don't want to go from 2.9 to a 7% mortgage rate. Right.
Yeah. Yeah.
Or even a 6%. I mean, you're going from 2.9 to 6. It's like, oh, should we double our mortgage rate and our payments? No.
Yeah.
Yeah.
No, thanks. Yeah. So, I mean, when mortgage rates dipped this summer, the buyer demand stayed cooler than expected.
Sure.
But now that the Fed is officially cutting rates, the article suggests we could see more buyers step back into the market.
Well, yeah, I think you will. I think you'll see some. It's kind of
Yeah.
like people who are sitting on the sidelines waiting for the Fed to make it official, even though in some cases the market had already started pricing it in. But it's not going to immediately or drastically affect mortgage rates enough. So it might help a little, but I don't see it helping a lot. That's the thing.
Yeah, exactly, Tony. So it's kind of like waiting for a concert headliner to announce, okay, the show's starting, even though the band's already warming up for 20 minutes.
Yeah.
By the time the Fed makes this announcement, lenders and investors have often priced in those expectations early. So again, we want to note NerdWallet survey done by a Harris poll found that 15% of Americans say they're planning to buy a house once rates come down. And so if you're in that 15%, this could be your sign to start looking sooner rather than later.
Yeah. Yeah. And of course, it's just a maybe that the rates will keep going down later in the year. And that's it. A lot of people are basically waiting on the sidelines for the all clear from the Fed, right?
Yeah. And true, that's true. But here's the catch. Fed Chair Powell was very clear in his press conference. Don't expect mortgage rates to return to those ultra low levels we saw back during the pandemic or even throughout much of 2010s. In his words, we're probably not going back to that era.
So in other words, if somebody's holding out for that 2 to 3% mortgage, they might be waiting a long time, if not forever.
Forever.
Right? So,
Yeah.
Yeah.
So, when sitting down with a financial service professional, we can help make those decisions on should we wait or shouldn't we? And it can make all the difference.
Yeah. And how can our listeners get a hold of you to talk about this?
Yeah. Again, the best way to get a hold of us is to reach out to us, give our office a call, 952-873-2703. Again, that number is 952-873-2703. Visit us online at pankoninfinancial.com. That's PANKONIN financial.com. While at my page, check out past shows. We got a lot of good podcasts out there now. We're starting to build a pretty good library on that. Or subscribe to our shows on Amazon Music, Spotify, Apple Podcast.
Yeah, there you go. I think that's fantastic. Now, today you've had some excellent information for us about what the Fed's recent rate cut means for people out there and their strategies and their road to retirement. You were talking about this NerdWallet article, and NerdWallet sounds funny, but it's a great site, great information. What do you have for us next?
Yeah, so the article explains the Fed's move was pretty much in line with what the markets had already priced in, which means we're unlikely to see a big drop in mortgage rates from here. And here's an important wrinkle. If the Fed cuts rate more slowly than the markets are currently predicting, there's even a chance that mortgage rates could creep up a little bit instead of down.
Oh, wow. Okay. Yeah. So that means that the bottom line is you can't wait for the perfect rate. The smart move is figuring out if the numbers out there can fit your bigger financial picture.
Yeah. And now, even if rates don't rise, there's other challenge buyers are facing. Home prices are still really high. In August, the median price of an existing home was over $416,000, according to the National Association of Realtors.
Wow. Okay. So that's a big number. How does that actually play out in a monthly payment then?
Yeah. So let's break it down, Tony. With a 10% down and a 7% mortgage rate, the monthly principal and interest would be around $2,500. And if that same loan was at 6%, it would be closer to $2,300. So yes, you're saving about $200 a month with that lower rate, but it's still a hefty payment. And remember, that's not counting property taxes, homeowners insurance, and all the other costs that come with owning a home.
Yeah. That means that even with lower rates, affordability is still going to be a big hurdle, especially, for first-time home buyers probably.
Yeah. That $200 a month is like cutting out a couple of streaming subscriptions or trimming back on takeout. It helps, but it doesn't change the fact that the overall cost is still significant. And that's why the real question isn't about trying to time the market. It's about whether the timing is right for you. So if you're ready and the home's affordable and fits your needs, it can make sense to move forward. Waiting for the perfect rate on a price sometimes means missing opportunities altogether. Another group that could see some relief right now is homeowners looking to refinance. People who have bought at that higher rate have been waiting for a break, and with 30-year rates hovering near 6%, there's millions of families that might have that opportunity. In fact, it suggests about 4.7 million homeowners could lower their rate by at least 0.75% with these lower rates.
Wow. Okay. So that's a lot of people out there. Yeah, it's going to be a big hurdle. People could be saving money every month, but how do you figure out if refinancing will actually make sense for you?
Yeah, the basic refi math is first figure out how much refinancing will cost. You can call your loan officer to get this figured out, but it's usually somewhere between that 2%, 2 to 6% of your loan amount. And then compare that upfront cost with your monthly savings at the new interest rate. And then you divide one by the other in order to get the break even point or the number of months or years before you actually truly start saving with that refinance cost.
And obviously, refinancing, it's a big decision. You might want to work with your financial professional to make sure it's in the budget, it's in the plans, and can I afford it? That's a big question.
Yeah. For some, refinance could mean freeing up real cash flow. For others, the cost might outweigh the benefit. And that's why running the numbers carefully is so important. And here's the flip side of the refinancing story. There's actually a much bigger group of homeowners who are sitting tight because their current mortgage rates are below today's levels. Tony, you talked a little bit about this for you personally, but according to the Federal Housing Agency, as the second quarter of this year, more than half of the U.S. mortgage borrowers are locked into rates under 4%. And that's incredible when you compare it to the rates that we're seeing today.
Yeah. And for those folks, myself and my wife included, the idea of moving right now feels almost impossible, like you'd be giving up a sweet deal.
Yeah, that's right. And the economists actually have a name for it. They call this the lock-in effect. It's the hesitation to sell when you know your next mortgage will come at a much higher rate. Research estimates that for every single percentage point that current rates are above your existing mortgage, the likelihood of you selling your home drops by more than 18%. That's a huge disincentive.
Yeah. Wow. Which explains why the housing market feels frozen right now, because nobody wants to give up a 3% mortgage for a 6% one, just like I was saying earlier.
Yeah.
But now realtors that I've talked to, their line is, and I don't know what you think of this, Ashton, but realtors are saying, but you're not buying a mortgage rate. You're buying a house. You're not investing in a mortgage rate. You're investing in a house. And when the rates, you can buy the house because you're not buying into a mortgage rate. You're buying into the house, and then you can refinance when the rates go down. That's their argument to try to get people to buy in this higher interest rate market. So,
not just higher interest rate, but higher housing price too.
Yes, there you go.
Current housing market. But
exactly.
Yeah. So, right now we're seeing it's called the have to move market. So people selling the house because of big life changes, things like divorce, job loss, or relocating for work. Those situations are where the sale isn't optional. But as rates inch lower, other motivations start to come back into play. Upgrading to a bigger house, or in your case, Tony, downsizing to a smaller one, moving to a new location. Those lifestyle choices may outweigh the fear of those higher monthly payments or higher interest rates.
Oh, okay. What it really comes down to is that each household has to decide where their threshold is and what's worth the trade-off, I guess.
Yeah, and I agree. And for some, the higher mortgage payment will still be worth it. It means finding that home that is better for their life. You mentioned kind of how the realtor sells you on it. Again, if it is time to upgrade, maybe you truly are just buying a temporary interest rate and then refinancing down the road to find that home that fits you better.
Yeah, exactly. And we've talked a lot today, Ashton, about how, lower interest rates help us when we're buying things. They might help our mortgages to go down, loans to go down. But on the flip side, it also means earning less on CDs. A lot of seniors have money in CDs or, MYGAs, like multi-year guaranteed annuities, which usually do a little better than CDs as far as interest payments, which is good. But even that interest rate might go down if they keep lowering rates. And especially you don't want your money in, at a bank in an interest-bearing savings account. If you have too much in there, those are going to start to get really low again, aren't they?
Yeah, they are. And, for a while their CD rates were good, 5% or something like that. And, but they'd only lock you in for like 3 to 6 months on those sometimes because they saw these rate cuts coming.
Yep.
So they didn't want to lock in. So I was taking that opportunity to maybe lock a lot of clients into like a 5-year MYGA, multi-year guaranteed annuity.
Yeah.
And so, it's before rates drop in those, there is an opportunity to try and lock in some of those longer term, higher interest accounts, maybe in that multi-year guaranteed annuity. And that's part of the reason why I like to go out 5 years for some of that money that they've just been renewing in CDs 1 year at a time.
Yeah.
Just to make sure we lock in that higher interest rate, because the Feds are more than likely still going to continue to cut rates here, whether it's
if you can lock in a higher rate into a principal protected plan like a MYGA, where your principal's protected, your rate's locked in for a longer period. Now you give up liquidity. There's always advantages. Yep. There's advantages and disadvantages to every single investment opportunity, whether it's putting your money in a bank, in a CD, in a MYGA, in an annuity, in a investment, money market, stocks. There's give and take. And, I saw just last week, there's a company, a top rated company. One of the companies is offering a 10-year MYGA with 5-point-something%.
Yeah.
And that's, to lock in over 5% for 10 years. Now you're giving up liquidity.
Yeah.
There may be some amount you can take out without penalty each and every year.
A lot of times it's 10%, but yeah.
Yeah. On that one, I think it's a little lower just because they're giving the higher rate for such a long period. But you have access to, you look at all those. You look at every company. You're not beholden. So I just want to tell our listeners, you're going to look at everything and say, this is in your best interest right now. It's not about you or what you can do. You are independent. You can look at all the options and say, here's what you should do. You could lock in at this right now, rather than leave a larger sum in a lower interest bearing account. That's the difference between those that are wealthy and have earned their wealth. They always constantly make their money work for them.
Correct. And we just had some clients who they had their money in at 4% in a savings account, and they dropped the rate. And so we moved it here to get them a little better interest. We kept plenty in the checking savings accounts for those emergency funds, and we had other liquid assets. And so, again, we take a look at that overall picture, see what's going to make sense as far as balance in the portfolio. We kind of keep different buckets, short-term buckets that are liquid, so you can have access to it. Some long-term or mid-range buckets are maybe in those MYGAs, and then long-range buckets are usually invested in the market, at least a portion of it.
Yeah, I think that's smart. Well, hey, great show today. Before we go, Ashton, let our listeners know how they can get a hold of you one more time.
Yeah, give our office a call here, 952-873-2703. Again, that's 952-873-2703. Visit us online at pankoninfinancial.com. That's PANKONIN financial.com. And one more quick thing, we are coming up on open enrollment for Medicare. So feel free to give our office a call to set up an appointment to talk about if you've got the right health plan in place.
There you go. I think that's fantastic. And listeners, that does it for today's episode of the Pankinen Financial Perspective with our host, Ashton Pankinen.
Thank you for joining us for Pankinen Financial Perspective. Don't head into retirement without a plan for both your finances and your health. For more information, contact Ashton Pankinen at Pankinen Financial Group at 952-873-2703 or visit pankoninfinancialgroup.com. Join us again soon for another episode of Pankinen Financial Perspective. Advisory services are offered by Ashton Pankinen LLC DBA Pankinen Financial Group, an investment advisor in the state of Minnesota.
All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a licensed sales agent.